Good evening, and welcome to our market report. Let's start with a quick snapshot of Friday's closing numbers. The Nasdaq finished at 26,281, essentially flat. The S&P 500 ended at 7,575, also unchanged, while the Dow Jones settled at 52,637, flat as well. The VIX Volatility Index held steady near 15, and the 10-year Treasury yield remained at 4.57%. The dollar index edged up slightly to 101.13, and the offshore yuan traded at 6.7841, barely moving. Bitcoin slipped a bit to $63,887. In commodities, WTI crude oil was the standout, rising over 3% to close at $73.65 a barrel. Spot gold gave back some ground, falling 0.68% to $4,085. Looking at the broader picture, global markets showed a clear structural divergence on Friday. Asian markets, especially China's A shares, came under heavy pressure. The Chi-Next index, which tracks growth stocks on the Shenzhen exchange, plunged 4.37%. The Shenzhen Composite Index fell 2.29%, while the Shanghai Composite and the CSI 300 dropped 1% and 1.96% respectively. Risk aversion was intense, with money flowing out of high-valuation growth stocks, though it remains unclear where that capital is rotating to. In the U.S., the three major indexes closed flat, but the futures market told a different story after hours. Nasdaq futures fell 0.5%, S&P futures dropped 0.29%, and Dow futures slipped 0.2%. This data suggests that while the risk of escalating U.S.-China technology restrictions has been fully priced into Chinese stocks, U.S. markets have not yet fully absorbed it. The risk of a catch-up decline in U.S. equities is rising. Now let's talk about the money flow. In the short term, cash and defensive assets like energy are the preferred destinations for. WTI crude oil surged over 3% last week, confirming that capital is flowing in on supply shock concerns. Gold, despite opening higher, closed lower but only by a small margin, indicating that safe haven money is not all rushing into traditional havens. In Asia, Friday's sell-off in shares was broad-based, with semiconductor and optical module stocks, previously strong performers, leading the decline. This directly reflects market panic over the technology restrictions. U.S. markets were closed over the weekend, but the futures decline already signals a bearish sentiment, and or catch-up decline, is likely on Monday. We identified a key asynchronous turning point. Chinese stocks crashed on Friday, but the U.S. futures decline is delayed. The Chi-Next index was the first to release risk and serves as a leading indicator for global tech stocks. U.S. pre-market futures, however, have not yet fully priced in the impact of the trade tensions. Our earlier morning report correctly predicted that shares would continue to fall and that money would flow into defensive assets. That direction was confirmed on Friday. However, we underestimated the severity of the Chi-Next sell-off, which plunged 4.37%. We did not fully anticipate the intensity of the tech sector rout. The biggest surprise was that the market initially ignored the severity of the U.S. technology export controls, which were announced on July 10. Chinese stocks then priced in that risk through a panic sell-off on July 12. Additionally, China's Ministry of Commerce over the weekend signaled a review of export controls on critical minerals. This could trigger a move in related sectors like gallium, germanium, and tungsten on Monday. Looking at the interplay between currencies and rates, the dollar index firmed slightly, while the yuan stayed within its recent range without any major depreciation. This tells us that the sell-off in Chinese stocks was driven by sentiment and risk appetite, not by capital flight through the currency channel. The 10-year Treasury yield held at 4.57%, a neutral to high level, and did not decline on risk aversion. This means money did not flow into treasuries but instead moved into commodities like oil. So we have a divergence, stocks under pressure, commodities strengthening, and rates staying high. For Asian markets on Monday, Chinese stocks may open lower but a quick rebound is unlikely. We need to watch whether foreign capital returns through the northbound Stock Connect channel. In terms of sector direction, energy is the strongest. WTI crude rose over 7% for the week, driven by the confirmed supply shock from the shutdown of a key Russian oil pipeline. Capital is likely to keep flowing into this sector. Critical minerals and rare metals are also worth watching, given China's review of export controls. The market may start repricing supply chain bottlenecks. The weakest sector is clearly Chinese tech and semiconductors, which face short-term headwinds. The probability of a market rotation into energy and commodities is about 60%, but this needs confirmation from Monday's open. Let me give you a directional conclusion. Our strategy for tonight into tomorrow morning is to hedge and stay on the sidelines. The bearish signals from U.S. futures and the unresolved geopolitical risks over the weekend argue against taking long positions. However, crude oil and critical minerals offer contrarian opportunities. We suggest maintaining a 15 to 20% commodity exposure in your portfolio as a hedge. If WTI crude breaks above $74.5, you can add to energy ETFs or related stocks. But if the dollar index breaks above 101.5, you should reduce all risk assets, including commodities, and move into cash or short-term bonds. Our probability assessment for today is 30% for an up day, 35% for a sideways move, and 35% for a down day. The market is waiting for a new catalyst, so stay cautious.